Okay, I just checked you guys can hear all right. Let me put the sound up a bit. Is the sound okay over here? It is. You want a bit more? More? How's that? Is that better? Ooh, right. Okay, how's that? Is that better? That's good. Okay. What about you guys at the back? You okay for sound up there? Yeah. And you guys okay? Yep. Right. Okay, so let's make a start. Just a couple of sort of administrative announcements. One is that the fourth online quiz opens tomorrow morning at 6 a.m. So if you want to do that, make sure you take the time to do it. The other thing is that this lecture time next week, next Monday, will be a guest lecture, and I'll have a guy from J.B. Weir here, a guy called Nathan Latimer, and he's one of the local fund managers with J.B. Weir, and he'll be coming in and essentially talking about what he does as a fund manager within that particular company. And the thing with this course is that once we get to the end of the 5 markets that we study, at that point it becomes reasonably worthwhile to bring someone in from industry who works in the finance industry and so talk to you about what he actually does or she actually does, as the case may be. And most students in years gone by have found those talks relatively interesting. The only downside to it, of course, won't affect you because you're here, is that he has asked that it not be recorded. So there will be no recording next Monday. And also the other thing about that is he also asked that the PowerPoint slides that he's going to present will not be given to you beforehand. So if you want to benefit, you definitely have to turn up. But there's plenty of space here, so if you know other people who might be interested in it, in what people do in the finance industry and managing other people's funds, there's plenty of room here. You might as well invite them along to listen. So it does give a legal disclaimer at the front saying that this is not financial advice, but it's quite interesting all the same. Okay, any questions on either of those two before we get into the topic? Okay, so we're on the topic of commercial banking, and most of last time we talked about the balance sheet of a bank, and there is a sense in which it's really not that much difference in terms of its structure from any other corporation. Essentially, the balance sheet has 2 sides. There is one side which tells you where it raised the funds that it has to go about its business, and then the other side of the balance sheet tells you what they did with those. The thing that makes the banks different to pretty much any other corporation is the ratio between the equity, which is the money essentially supplied by the owners in one form or another, and that which is borrowed. Typically, if you look at a corporation, if they have over 40% debt, they tend to be considered to be highly levered. And there are certainly plenty of corporations out there that have no debt on their balance sheet at all. They're simply funded entirely by equity. Now, a bank is quite different. And we drew this diagram here, or we were in the process of drawing it last week. Equities and liability, equity is slightly different from capital, but we'll call it capital now. This is where the funds come from. So things like share capital, retained earnings from being profitable, and then reserve accounts so you have to write off losses. That essentially is money that is, in one sense, directly attributable to the owners. The owners have put these funds into the company in one way or another, and that tends to only form less than 10% of the funds that they've raised to go out about the business. All the rest of it is borrowed in one form or another. And we then went to split up the borrowing piece, which is typically in excess of 90% of the total amount of money they have, into several pieces. And so the 2 pieces here, 2 broad pieces, are deposits, this group here, and then other things we call borrow funds here. And then we split the deposits into 2 pieces, the transaction type account, which is money which can be withdrawn right now, today, to buy and sell things. And then there's longer term ones like term deposits and savings accounts, which tend to be the money that's put aside to store value, rather than this was here, which is money for transaction. Now, in terms of cost, the transaction accounts, these types of accounts often have no interest at all. So these are your low-cost funds as a bank. the term deposit and savings accounts will pay a higher rate of interest, and so they're a little bit more costly. When we go to the second group down here, which, although this stuff is borrowed as well, this group down here tends to be called borrowed funds. These are things that are raised on the open market in one way or another. For example, money markets. A bank may be issuing bank bills on the money market, and so there's a group of them there. They may engage in repos for short-term liquidity needs, and then they may have issued some bonds as well on the open markets to raise money for their business going on. And again, the cost is different. Money markets, repos tend to be low cost compared to bonds. Bonds tend to be high cost, but of course, bonds, you have that money. Say if you issue a 5-year, or like one of the banks did quite recently, a 15-year bond, then you have that money on your balance sheet for 15 years. Whereas money markets are short term, repos very short term, and so that money turns over quite quickly. Then we looked at the other side of the balance sheet. We hadn't actually finished drawing this one, but we'll finish it off today. The asset, which is basically what did they use the funds that they got to do. And so in terms of the structure of it, what we have at the top there is things that they have on the balance sheet specifically to meet the liquidity needs. So as people draw money out, whether they go to an ATM, pull out cash, use an FPOS card or something like that, this stuff up at the top there is to meet that liquidity needs. So notes and coins, obviously. Reverse repos, so if they raise short-term money for liquidity needs. And any accounts they have at Reserve Bank, they have a group of stuff up there at the top, which is there to meet that need that they have as a bank for the liquidity. And if you think about, well, what's that going to earn them? Typically, it's in the range of about 0, maybe as high as the OCR. So this tends to earn very little. Then there's a second group, which they call investments. That's this group in here. It's often split into two pieces, at least. This piece in here, the way we drew it, we had a government bond as an example of what they might have in this piece. And this is the stuff that we say is available for secondary liquidity. So a bank always has to have a certain amount of liquidity on its balance sheet to meet withdrawals. And if their main liquidity starts to run down because they're getting withdrawals for various reasons, that starts to shrink out, this stuff is not available as liquidity right now, but it's the sort of stuff that you could go and trade very quickly. Like, for example, a government bond, you could trade as part of a repo to raise liquidity. So that tends to be what you call secondary liquidity. And then there's other group in here, an example we gave with the corporate bond, is that they have these type of investments when they have money that they need to invest, but they haven't got anything in terms of good loans to make right now, and so they tend to put them into something that they can sell relatively quickly, like a corporate bond. And we're looking at what they will earn on this. Typically, government bonds, corporate bonds, will earn you more than the OCR. So they earn more than that. And then the next group, which we talked about, were the loans and leases. Typically, of a bank, that forms about 2/3 of all the assets they hold. But their downside is they're very illiquid. They also have significantly higher risk in terms of default risk. But when you're thinking about how much will they earn off this stuff, this is where they earn their highest return. And so we still have this bit down here, this final bit to fill out. We'll come to that. But right now, because this is their main, the main source of their income for a bank, we'll take a little digression at this point, and we'll look at how they actually price the loans, which basically in terms of what interest rates they will charge on that. So, going back to loan pricing, what factors go into setting a loan interest rate? If you are a bank, you're a bank manager, and someone comes in to talk to you about loan, how would you decide what interest rate you would charge them? What factors would you have to consider?
Consider market factors such as OCR, competitors' interest rate settings. Also, you need to consider the borrower's condition.
Okay, so there's several points in there. One is the market conditions, and there's several things in there like what is the current cash rate at the central bank? What is the competitive market like? So because you're not the only bank in the world, so the competitive market to consider. And then the third thing that was that you have to look at the borrower themselves and make some decisions, basically sort of things like how much risk are you taking with this particular borrower. Anything else you would consider? Yep, go ahead. What it is they're borrowing for, and how would that affect you as a bank? How would that influence your decision?
Like if it was a house based borrowing for a car.
House versus car. And so the issue there is like, if you're thinking of, always bankers always think of terms about what happens if they default, my recovery. You're looking at security. And of course that, question is in terms of risk premium, what's the probability of default? If they default, how much will I lose? If it's a house, you lose far less than if they bought a car. And so that factors into your interest rate. Anything else? Okay, so let's roll over and see if we missed anything. I think we got most of them. One we kind of, missed this one here almost. The cost of funding the loan. So you have a cost of funds. Basically, you average out all your cost of funds of how much you're having to borrow, because most of the money that you have to make this loan is borrowed one form or another. And so you've got to have an interest rate that's going to cover that. The other thing we didn't get was this one here, was that there's administrative costs. So initially, you have to analyze the person who's come in, or whether it's a business, have to analyze and do a credit analysis. That's costly. And then once you made the loan, you don't just make the loan and forget about it. You monitor it over life, and that's going to cost you money as you go along, so you've got to cover that as well. But we talked about these ones, these risks. This one here, interest rate risk, again, that's a sort of a market-related risk which you have to factor in. Okay, so breaking it down to these four pieces, if you're going to set an interest rate, what are these things? A base rate, a default risk adjustment, a term to maturity adjustment, and a competitive factor. So what's a base rate when you're setting an interest rate for a loan? What's a base rate? Yep, go ahead. Okay, more like something like an OCR. There's usually some benchmark that you work against, and typically in New Zealand for loans, the benchmark that they tend to work against is the 90-day bank bill. But things like if you're overseas, the LIBOR is a common one. If there's a benchmark in terms of the bank bill swap rate, they might use that as a benchmark. So there's some benchmark out that they use, and that's the sort of the bottom rate for loans. So basically, that's the bottom loan. Then you've got to add other things on top of it. So for New Zealand, the 90-day bank bill is one of the key rates that goes into setting an interest rate. So we've talked about default risk. What's a default risk adjustment?
So the bank is going to consider, just like you said before, what kind of investment this borrower is going to put the money in, also that if this loan is based on asset back.
Okay, so there's one is the actual type of loan that you make, and there's a probability that, because all loans have some probability of default, that changes from person to person, loan to loan type. So the probability of default is something you consider there. And then the second point that you were making was that whether there's an asset there, particularly we call this collateral, if there's been some security offered, yeah, you have to consider that, because the second question after probability of default is, if it does default, how much will I lose? So you got to work that out somehow. What about a term to maturity adjustment? What's that?
How long the loan is?
Okay, so that's how long the loan is, but how does that affect the interest rate that we're going to charge?
We're going to affect the interest risk, which is if the maturity is longer, then you have more interest risk.
Okay, so the key factor, we've met this before, the interest rate risk, the longer the time to maturity, and particularly the key thing is the longer the time until you get an interest rate review, the higher the interest rate risk is. So basically, if you're going to make a loan, a fixed rate loan for 5 years, you're going to want some sort of term maturity and illiquidity premium to go above that because of that. And you want one if that's higher than, say, for example, if you make a floating rate loan. So what's a competitive factor? Other banks, yes, that's another place. You don't want to run down the road to the next bank. Where else could they go?
Maybe if it's like, the house is going
Okay, so you could go to another sector in the financial system somehow, like finance company, although they tend to charge you more. But you could pull your money out of your KiwiSaver. Yeah? If you were buying your first house. One other thing about that in terms of the competitive is that some, particularly corporations, they can access the direct market. So you've got to think about that as well. If they can access the direct market, then your ability to charge high interest rate is severely reduced compared to somebody who can't. So they're not all the same for all customers. Got to, let's see where we go. So there's your base rate. Now this is how they got this little formula here for calculating it. So there's your base rate, your default time to maturity, and then your competitive factor. So here's an example of how it might work. So we've got some data on these two companies here, a large firm and a small firm. The bank's base rate is 5%. Okay. Basically, that's pretty much the same across the board. Doesn't matter who wanders in off the road. Base rate pretty much same for everybody. But then you've got to take into account the various things that will adjust the interest rate. So the large firm says well known, it's sold commercial paper on occasion, and it wants a floating rate loan. So that's what it's come in to get. The small firm wants a 1-year fixed rate loan, 1-year Treasury securities sell for 75 basis points above a 3 months Treasury bill. So it's kind of obvious where the first 5% comes from. But why are these two here different? Looking at that, the information we have, why does one get charged 3% and the other get charged 2%? Credit rating? It's unlikely the little one will have a credit rating, but the large firm might. But in general, you would expect what?
So if the large company have a lower probability to default, so they definitely going to charge less for create risk premium.
Okay, so your claim is that the large firm is less likely to default, therefore they charge a smaller premium. What about that data tells you that they're a strong firm? Yeah.
For the smaller firm, the interest payment will make up a larger percentage.
It does depend on the size of the loan, but the point is that the interest payments would make be a larger percentage of the interest. It does depend on the size of the loan that they're taking, but maybe that might be the case. What is it about the data we have about these two firms that tells you that that large firm has got a low probability of default?
Because they selling commercial papers
Yeah.
before
Yeah. It's this bit here. It's sold commercial paper on occasion. And remember back to the commercial paper section within the money market section, the only companies that get to do this are ones with very high credit rating. So the fact that they've done it in the past, assuming nothing's changed, means that they're a very solid company. So default risk adjustment there, little firm has to pay more. What about term to maturity? The large firm has 0, small firm has 0.75%. Why is there that different? Yep, go ahead.
So large firms are floating rate loans, so we're not going to have any interest rate risk from that.
Okay, first up, large company is on a floating rate loan. So there's no term to maturity adjustment. They can simply fix that interest rate up and down as the interest rate floats around. Okay? So that's why large ones are 0. What about the other one? Why is it at 75 basis points, 0.75%?
Because it says that the 1-year Treasury security sells for 75 basis points.
Yeah, so this is where that number comes from. This one here. There's the Treasury security. A 1-year one sells for 75 basis points above the 3-month, and that's where that number comes from. So that's where that one comes from. Now, going on to the last one, competitive adjustment. Little firm got 1%, big firm got nothing. Why is there that difference?
The large firms apparently has more channels to access funds, while the smaller say because of the size of the firm and the credit rating of the firm. So they have lesser channels to access the funds.
Okay, so the basic thing there is, what is the competitive market? The large firm has more options open to it for getting its funds elsewhere. The fact that it's gone out in the commercial paper market could go to the direct market itself, probably a good customer to pick up by another bank. You don't want to drive it away. Whereas a small firm has less options open to it to find its funds. So, it's a good bank, you can squeeze them a bit harder and they won't run away, you hope. So putting all those things together, you end up with a difference in the interest rates. And when you see the interest rate on the bit of paper in front of you that when you're signing away, one is at 9 3/4 and the other is at 7. And all this stuff, as a customer, you don't see that. They do all this stuff without giving it to you. But that's the type of thing that they'll think about when they're setting an interest rate on a loan. Okay, any question on that before we move on? Yep, got a question?
I'm just wondering for this firm for the large firms and small firms, can they do swaps?
I mean, after they've got their floating rate and they've decided they want to turn it into a fixed rate, could they do a swap?
Yeah.
Yeah, they probably could. I mean, you'll probably find that a bank would enter into a swap with them.
So if it's if they're able to do the swap, so the large firm has to assume the large firm has 1 year so to match the maturities in order to do the swaps to integrate.
Yeah, the thing with this, there's not enough. In one sense, there's really not enough data to tell us whether it's actually worthwhile them doing a swap. So to make a swap worthwhile, I mean, it says that they want a floating rate loan. So to do a swap, they'd have to take out a fixed rate and use a swap to transform it into a floating rate. And as long as the conditions were right to do that, they could go ahead and do it. We don't have enough information to tell us whether that's actually worthwhile here. We just don't know at this stage. But there's no reason why they couldn't do it if that was going to be a cheaper source of funds than going for a floating rate directly. Okay, any other questions? Okay, moving along. So what are these things? Non-price adjustments to a loan, and how do they affect the cost of a loan? What are non-price adjustments? And what do they do to the price of a loan? Oh, very quiet. Ooh, right. Okay, these are things that they don't appear as an interest rate, but they definitely affect the cost of the funds you borrowed. For example, compensating balance is something that you can run into, and you may give a loan, but they may require you to hold a certain amount of money in another account. For example, if you're say a corporation and you've borrowed $1 million and you have other accounts with them, there may be some minimum balance that is required. And so if you think about what's happened, although they've granted you $1 million loan, you actually don't have access to all of it because you've got to have a certain amount in this other account. And so what that does is, although the interest rate is on the $1 million, it's effectively shrunk the size of that loan, and that's put the costs up for you. So it gives you a net effective interest rate increase without actually having to actually charge you at a higher interest rate. Other things they can do, if they're going along, sometimes they can say you've changed risk profiles. They can simply shove you over in a different risk category and change an interest rate. That one actually does change the interest rate, but they can say it with a straight face because it was actually a risk change. Other things that they can require, security of various forms, collateral. by putting that up, in one sense, what it does, because it reduces the losses to them if there is a default, and without reducing the interest rate at the same time, essentially, give them a higher return for their money. And the other thing that's quite common is you might want your money for a certain length of time. Say you want it for 5 years, but they may only grant it for, say, 2 years before you get your first interest rate review. And what that does, it essentially gives them a greater flexibility in altering the interest rate in the future. And so instead of having the money for the full length of time that you want it at the interest rate that you want to pay, you're exposed to an interest rate risk. And so that's an interest rate risk that you have that they've been able to move on to you rather than themselves holding it. So that can affect your cost of funds over the life of the loan. So any question on that before we go to the next slide? Okay, fine. So the next one is when we talk about the costs of origination, that's first thing is they have to analyze the borrower, and then once they've analyzed the borrower and made a decision on granting or not granting the loan, then they have to monitor it. This is typically what they think about or look at when you go and apply for a loan. So the first one up there, the character, is if you're a regular customer of the bank, over the time that you've been banking with them, they have a lot of information on you about the transaction, types of transactions you're making, whether you've got a credit card with them, whether you have other loans, how you paid those ones, and so on. And so they'll look at that in terms of character. Basically, have you met your obligations in the past? And if you have, then they're more willing to loan more. So the capacity to pay, if it's a business, typically you have to take in your accounts, look at the cash flow for the business. If it's somebody like an individual, you'll have to take into them a pay slip or something like that so they can see how much money you earn. Typically you have to take in a budget of some sort, or often they'll ask you enough questions, they'll figure out how much you're spending and how much free cash flow you have and whether you can actually pay off the loan over time. Capital or wealth, basically you have to provide them a list of assets you have. Kind of sometimes surprising a little bit what they want to know, but anyway, basically this tells them how financially well off you are when you're coming in for a loan. Security, fairly obvious, like for example, if you're buying a house, you'll almost certainly put up the house itself as collateral in the mortgage. Now, another thing they may consider, or should consider, is the economic conditions. And so, for example, if economic conditions are not particularly good, even though a person may have a job today and look like they'll be able to pay the loan today, you have to consider how secure is the job they have. What would happen if they were made redundant, got restructured out of a job, or something like that. And so the general economic conditions that they're living and working in, you need to consider that. And the last thing there is what's called control. There are definite laws around non-discrimination in loans, but also you'll find internal to any organization that makes loans, like a bank, there's a whole bunch of internal policies there. And so you, as a loan manager, will have to comply with those policies in issuing or not issuing, as the case may be. Now, the alternative way of doing it, in one sense, this is the costly way of doing it. And one hopes that one's rewarded with a better analysis. But another way of doing it is credit scoring. And there are businesses which essentially make a business out of doing this. And they simply collect data on people from a wide range of sources. And then when they want to do a credit analysis, this thing simply dips into the database, looks at your history, how your payments have gone, what you've owed, how much you borrowed, how much you paid back, and all this sort of stuff. And you put in some new stuff, like how much new debt you have, and what type of debt are you wanting. And in a matter of a few seconds, that database, they pull that information out of the database, software crunches the number, and you get a score. And this is tend to be low cost, and one of the things it can do, which is really quite good, is it can allow the loans manager who's driving around the car with a laptop to arrive up to you and put in the stuff and actually decide on the spot whether you can get a loan or not. which is quite good. You know, if you're actually standing outside a house and want to buy that house, and the loan manager arrives in the car, and they sit down with on their laptop, and they can sometimes, quite often, on the spot say yay or nay. So that's quite good. But that is low cost, and one sort of suspects that it's probably going to be less accurate. Okay, any question on those before we move on? Okay, there's heavy. Right, roll over. So this brings us back to, that was a little digression on the pricing of these things, and we're into the last little section down here of what they've done with their funds, and there is another group of assets that they have. And so in the bottom one there, the assets, obviously, there's real estate if they own their own buildings, or rather, and they're not renting. Anything associated with banking, a ATM teller machine there that that's owned them. So computer systems, and then there's these intangibles as well. For example, brands, a brand name. The brand of A and Z has a value. It ends up on your balance sheet, but it's an intangible. You can't go out and touch a brand, but they do have value, and that sits on the balance sheet down here in the bottom part. And often the return on that is typically relatively low. I mean, it's usually, when you think about that, it's necessary to do the business of being a bank, but you don't really earn much off it. You may get capital gains if you own some of your real estate, but something like a computer system has a value now, but it is depreciating, tends to be bad. Lose money about time. Again, the intangible for your brand, it may increase in value, but there's no cash flow associated with it. Yeah, I think most of that. Yep. Right. Any questions on that before we move into the off-balance sheet stuff? Okay, moving along. So we've met off-sheet balance sheet before when we were talking about this in the section on the regulators. Okay, so this should be a bit of a review. What do we mean by off-balance sheet? What are they? When we're talking about off-balance sheet things that they're doing as a bank, what are they? What sort of things are off-balance sheet? Ooh, everybody's gone quiet. Right. So there are things that off-balance sheet. We talked about as being contingent liabilities and assets. So these are things that may or may not become either a liability or an asset in the future. A good example is, say a bank is being called upon to provide a line of credit to back the issue of commercial paper, something we've talked about in the money market section. Now, under normal circumstances, the company that is issuing the commercial paper will just simply pay the back in the normal course of their business. In the event that for some reason they don't get the funds that they think they will get and they're unable to pay that, then the bank will be called upon to pay, make the repayment of the commercial paper. So what this is for the bank is, let's say it was $100 million of commercial paper. When they make this commitment, it's not on the balance sheet because they haven't made any loan at all. Under normal circumstances, they will never make a loan on this stuff. But they promise to do it. And one of the reasons they do this, as far as part of business is that often it costs money to set this up, and so they earn fee income from providing the service. Now, in the event that they're actually called upon to make that payment, say the commercial paper comes up for maturity and the company cannot repay it in full, then the bank will be called upon to make the payment. So what happens is that this thing which was not on the balance sheet, it becomes a real asset for them because now the company that issued the commercial paper now owes them the money. So let's say, for example, of this $100 million, The firm could only pay $50 million back, calls upon the bank for the other $50 million, and what happens is that of that $100 million of contingent liabilities, contingent asset, $50 million of it comes onto the balance sheet as a real asset. There's a loan that they have made. They'll be charging interest on this, and the company that issued the commercial paper will now owe this $50 million to the bank. So a lot of this stuff has grown over time, and from the bank's point of view, why it's good for them is they earn fees off this stuff. And it's particularly good if they earn fees and they don't have to actually ever make a loan. Right, let's see. So here's a whole group of them, and we've got a number of slides over the next set of slides that covers each of these. So loan commitments, if you've issued a loan but the people have not drawn that money down, then the value of the loan that has not been drawn is a contingent asset. As it is drawn down, it becomes a real asset. Letters of credit, we've met those before. Let's go forward. Letters of credit, we met this before, particularly in bankers' acceptances, where they're trying to solve a problem with trade. And so there's three customers. Here there's the bank, there's the bank's customer, which asks for the things, and then there's someone who's the beneficiary who gets paid at the end. And typically, they're set up in such a way as the payment occurs in the future. Say you're going to issue a 90-day, eventually structuring in such a way that you issue a 90-day bank-accepted bill. What that means is that 90 days from now, the thing will come due. And in the interim, it's not on your balance sheet as a real item, but ultimately it will come there. Standby letters of credit, again, widely used in trade, and the bank guarantees its clients' financial performance of a contract, particularly if you're importing or selling goods in a country. The buyer is supposed to pay, but sometimes they'll ask for a letter of credit, which essentially guarantees that payment. And if the customer doesn't actually pay as they should, then the bank is called upon to make the payment. And you can see how that's as a contingent liability at the start, and may or may not become a real, contingent asset, may or may not become a real asset depending on whether the customer pays as they should. Okay. So derivatives. Derivatives, again, if you think, for example, let's say, take it as an example, a forward on some sort of foreign exchange. Why would that be a contingent asset or liability? When does it become a real one?
They hold a long position. If the interest rate is going to drop, so they're going to lose money, so then there would be a liability to them. On the other hand, if the interest rate rises, then they're going to make money, it would be the asset.
Okay, it's not just the long position. It's both long and short. Depending which way the price moves, they can actually have a loss on their contract or a gain. So just, for example, take the price moved up. If they're in the long position, that benefits them. They have a gain. If they're in the short position, they have a loss. And the opposite if the price goes down. And because they're dealers, they tend to have both positions with lots of different customers. But the thing is, if you think about a forward as compared to, remember this, when we did the talk about the futures, and the forwards, typically what happens, you set it up, and then there is no cash flow until you reach maturity. That's unlike a futures, which you set it up, and there's this daily marking to market by the exchange. And so if you have unrealized gains or losses, and depending where you are, you can have a gain or a loss depending on what the price did and what side you took. Those are contingent liabilities if you have a loss. They're contingent assets if you have a gain. But they don't become real until such time as you reach maturity and that final cash flow is paid. So ultimately, if you lose, then it becomes a real liability. If you've gained and you reach maturity, then it becomes a real asset. And so in the interim between when its contract is signed and maturity, it's contingent. If you gained, you have a contingent asset. if you've lost, you have a contingent liability, and becomes a real one at maturity. So in terms of using them to hedge, that's okay for as far as regular concerns. Speculating, they don't like it, but it's really hard to tell the difference. What about this one, selling loans? Why? I mean, think about what a bank does. It makes loans and normally it keeps them and makes its money. Why would a bank sell loans? And how does that benefit a bank?
First, they can diversify the loans.
Okay, so they can diversify in the sense like they can sell, if they got high concentration in loans, they can sell some of them and then go buy some other ones. So diversification is one reason they might do it? Yep.
So they could gain profit margin from selling the loans.
Profit margin, like if they made it at one interest rate, and the interest rate, for example, has dropped, and the loan has a high interest rate, they got a capital gain on. Is that? Yeah, they could do that. Yeah. Okay. Any other reasons? You might? Yeah. Go ahead.
If the loans is long-term, they might need short-term liquidity.
Okay, so if you've got a long-term loan, you might need liquidity, so you might sell a loan. Usually that you get squeezed if you do that, but yeah, I mean, definitely that has happened at times. Anything else for why they might do this? Okay, those are some good reasons. I think there's at least one more. There's one more. In terms of a bank which is highly regulated, if you think about how we calculate the capital adequacy ratio, one thing that you can do to avoid having to carry capital is you can simply sell loans. So, for example, if you think about, let's see, put both of them up here at the same time. The capital adequacy ratio is basically you risk weight all this stuff over here, and you put that on the top in terms of the ratio. Now, one of the things you can do if you're a little bit low on capital is you can shrink the size of your balance sheet by selling these things. So instead of being forced to go out and raise more capital in the market somehow or retain more earnings, you could sell these. That shrinks the amount of the size of your assets, and that then ends up meaning that you can carry less capital. So that is done from time to time, yeah, probably not much more to say about it than that. Now, this does actually, when they do this, one of the arguments that's made for doing this is that a bank has a significant advantage compared to most other institutions in the origination process. That's the process of doing the credit analysis of the customer and ultimately deciding whether they get the loan or not. And what they can often do in this type of arrangement is instead of simply outright selling the loan and then they have nothing more to do with it. I mean, if you had a loan at the bank and the bank sold your loan to somebody else, you'd probably get a bit upset with them. And so what tends to happen is that they actually retain the management right, and for that they will earn some small management fee. And so by doing this, they do increase the fee income relative to the interest income. And, oh, sorry, missed the securitization. Yeah, so the second point here about securitization, this has pretty much the same reasons why they actually sell loans, to go to securitization. We talked about this once before about how securitization is done. They take a group of relatively uniform loans like mortgages, they sell them into a special purpose vehicle, and then they turn those into securities, which they then on-sell to the end investor. And so from the bank's point of view, again, if you do that, you shrink this side of your balance sheet, which means you can hold less capital. And the other thing about that tends to be is that you don't sell them and forget about them. You retain the management rights. And so whoever say, for example, if certainly if someone is paying a loan to the ANZ, and say, for example, the ANZ securitized it and sold it off, you as a customer of ANZ see no difference from your point of view. You're still paying the ANZ, and the ANZ will then pass your money through to the end person who's bought the securitization security, and they'll take a fee for doing that. So that increases their fee income while reducing the cost of holding capital and so on. Often now they can underwrite securitizations, which means they'll actually earn an underwriting fee. But it's quite rare to see this done in New Zealand. You don't see this much done here, but it has been very common overseas. And in fact, this is where one of the big problems in the financial crisis came from, is from all this securitization that went on there. Okay, any question on that before we... Yep, got a question? Go ahead.
Is it SPV in New Zealand?
A special purpose vehicle. Yeah, it's just a sort of name for a legal entity. Now, the places where it has been done, it's done like anywhere else. They create these things, they take the loans that they have, they sell them into them, they turn it into something that looks like a bond, and that's the thing that gets sold to the end investor. And there was I can't remember the name off the top of my head. There was a company that made motor vehicle loans that was doing this. It was securitizing their loans, and Kiwi Bank has done it as well. Kiwi Bank has securitized groups of loans in the past, but it's not common. It's not common. Any other questions? Right. So that actually wraps up that half of the thing. So we'll start. We'll stop at this point, and we'll start tomorrow on the second half of that, with this topic, which is this one here. So we'll start at this point tomorrow. So if you want to ask any questions, be around for a while. Otherwise, we'll pick it up at this point tomorrow.